President Trump just signed an executive order that, on the surface, looks like a retirement policy. But if you look at it as a system, it is much larger than that. It is not only about helping people save, it is not only about creating another retirement account, it is not only about giving lower-income workers a match, it is about changing where money flows in the American economy. And when you change where money flows, you change markets. That is the part most people will miss. They will hear the phrase Trump IRA and think, this is a political story. They will hear the phrase retirement account and think, this is a personal finance story. They will hear the phrase government match and think, this is free money. But in a debt-based economy, free money is never only free money. It has to come from somewhere. And when the government is already spending far more than it collects, the somewhere usually becomes debt, and debt eventually becomes more pressure on the dollar. That is the real story. So if you want to understand this new retirement system, you have to see both sides at once. On one side, it may give millions of workers access to investing in a way they did not have before. That matters. On the other side, it may require more government borrowing, more liquidity, and more dollars flowing into financial assets. That matters too. A good investor does not only ask whether a policy sounds good, a good investor asks what chain of cause and effect the policy creates. Who receives the money? Who pays for it? Where does the money flow? What assets benefit? What risks are created? Who understands the game early and who only understands it after prices have already moved? That is how I would look at the Trump IRA, not as a slogan, as a system. The system begins with the weakness of the 401k for decades. The 401k has been the main retirement machine for millions of Americans. The structure is simple. You work for an employer. If your employer offers a 401k, you can put part of your paycheck into that account. That money is invested over time. It can grow inside a tax-advantaged structure. In a traditional 401k, you contribute pre-tax money. That reduces taxable income today. The money can grow without annual taxation inside the account later. When you withdraw it in retirement, you pay taxes then. In a Roth 401k, the sequence is different. You pay taxes up front, you contribute after-tax dollars. The money can grow, and later qualified withdrawals can come out tax-free. Both versions are powerful because they put money into a long-term investment machine. That is the good part. But the 401k has structural problems. The first problem is access. A 401k is tied to an employer. If your employer does not offer one, you cannot use that workplace plan. That leaves out many workers, gig workers, Uber drivers, part-time workers, small business employees, low-income workers, people moving between jobs, people whose employers are too small or too disorganized to provide a plan. According to the framework in the source, about 56 million workers in the United States do not have access to a 401k. That is a very large number. It means a massive part of the workforce does not have the same easy pipeline into the stock market that higher income corporate workers often have. And access matters because systems create behavior. If your paycheck automatically pushes money into a retirement account, investing becomes easier. If your employer matches contributions, investing becomes even more attractive. If the account is already there, the worker does not need to figure out every step alone. But if the worker has no employer plan, no match, no automatic setup, no low-fee menu, and no clear structure, the friction rises. When friction rises, participation falls. This is a basic principle. People do more of what systems make easy and less of what systems make hard. The second problem is fees. Many 401k plans have investment options with high expense ratios. Some plans are reasonable, some are very cheap, but many include funds and administrative costs that quietly reduce the investor's ending wealth. Fees are silent because they do not feel like a bill. You do not write a check every month to the fund company and feel pain. Instead, the fee is deducted inside the system. The account grows a little less than it otherwise would have. The difference compounds for decades. By the time the worker realizes what happened, the money is gone. That is why fees matter so much. A 1% fee does not sound like much, but over 30 years, a 1% annual drag can take a large share of the ending portfolio. The source uses the average 401k fee of about 1.26% in 2025. That is the number that matters because retirement is a compounding game. If someone invests $500 per month for 30 years and earns 8% before fees, the account might grow to around $679,000. That sounds like a serious retirement balance. But if the average fee is 1.26%, the ending balance may fall to around $540,000. That means roughly $139,000 disappears into fees and the lost compounding on those fees. The worker did the hard part. The worker contributed every month. The worker stayed disciplined for 3 decades, but the system quietly took a large piece. Now compare that with a much lower fee, like 0.15%. If the returns are similar and the fee is only 0.15%, the ending balance might be closer to $660,000 with far less loss to fees. This is why a fee cap matters. Not because 0.15% is magic, because the compounding difference between high fees and low fees can be enormous. In long-term investing, money not lost to fees remains inside the machine. And money inside the machine compounds. That is the principle. The third problem is portability. A 401k is linked to an employer. If you leave job A and go to job B, the old 401k may remain behind. You may need to roll it over. You may face paperwork. You may have different plan rules. You may have a different investment menu. You may forget about the old account. You may cash it out by mistake. You may feel stuck or confused. This creates friction, and friction is the enemy of long-term wealth. Building the modern worker changes jobs more often than prior generations. Gig workers may not have one stable employer at all. The retirement system built around one employer for one long career does not fit the way many people work today. That is a structural mismatch. The fourth problem is minimums. Some retirement systems and investment options create a psychological or practical minimum. You may feel you need $50 a month, $100 a month, or a certain account size to begin. For low-income workers, that can be a barrier. If the minimum is too high, people do not start. But wealth building often begins with small amounts. $5 matters if it creates the habit. $20 matters if it starts the system. The first dollar matters because it changes identity. A person who invests even a small amount becomes a participant in the asset owning system. That is important. Now, the Trump IRA is presented as a response to these problems. Its stated design is different from the 401k in several ways. First, it is not tied to a specific employer. It is meant to be available to workers in the United States, even if their employer does not offer a 401k. That makes access much broader. Second, the fees are supposed to be capped at 0.15%. That directly targets one of the biggest hidden drains in the retirement system. Third, it is portable because it is not attached to one employer's plan. If the worker changes jobs, the account remains connected to the worker rather than the company. Fourth, it reduces the minimum investment barrier. The source describes the ability to start with as little as $5. Fifth, and most politically important, the government can provide a match to qualifying workers. That is the part that changes the system. A 401k match usually comes from an employer. If you put in $1,000, the employer may contribute $500 or $1,000 depending on the plan. That is one of the best wealth building benefits available to workers because it gives an immediate return on contribution. But many low-income workers do not receive that benefit because they do not have a 401k or do not work for an employer that offers a match. The Trump IRA attempts to create a government match. The source describes a structure where qualifying workers can receive up to $1,000 per year from the government if they meet income requirements and contribute enough of their own money. This is not a one-time bonus in the source's framework. It can be annual. That is important. If a low-income worker contributes $2,000 in a year and qualifies for the full match, the government may add $1,000. That is a 50% match. A 50% match is powerful. If you can put in $2,000 and receive $1,000, that is an immediate boost before market returns even begin. For a low-income worker, that can make investing feel possible. But there are income limits. The source frames the full match as applying to single filers making under about $20,500 and married filers under about $41,000. Then the match phases out for single filers up to about $35,500 and married filers up to about $71,000. Above the phase-out range, the government match disappears. That means the program is targeted. It is not for high earners. It is for lower-income workers and some moderate-income households. From the personal finance perspective, that is meaningful. A worker without a 401k, without an employer match, and without easy access to low-fee retirement investing may suddenly have a direct channel into the market plus a government contribution. That can change behavior. But from a macroeconomic perspective, we need to ask what happens when the government creates an annual match for millions of people. The money has to come from somewhere. That is where the story becomes larger. The United States government already spends more than it collects. The source uses a rough framework in which the government may collect around $5 trillion in taxes and spend around $7 trillion. That creates a deficit around $2 trillion. That gap is not imaginary. The government covers it through borrowing. In simple terms, the government spends more money than it has, so it issues debt. That debt is purchased by people, institutions, foreign governments, pension funds, banks, and sometimes directly or indirectly supported by the Federal Reserve System. If the government adds a new program that sends matching contributions into Trump IRAs, expenses rise. If taxes are not raised to fund it, the money must come from more borrowing. If borrowing rises, the debt rises. If private and foreign buyers are not enough to absorb the new debt at acceptable rates, the Federal Reserve may eventually become part of the financing system through monetary expansion, and monetary expansion has consequences. This is why the source says the most expensive kind of money is free money. That sentence sounds dramatic, but the principle is correct. When the government gives money, it either taxes, borrows, or prints. Taxation takes purchasing power directly. Borrowing takes purchasing power from the future. Printing dilutes purchasing power across the system. None of those are costless. The public may receive the money in one pocket and lose purchasing power in another. This is how inflationary systems often work. A person receives a benefit, but the currency becomes weaker over time. Asset owners may benefit because more money flows into stocks and other assets. People who live mainly on wages and savings may be hurt because prices rise faster than their income. That is the hidden transfer. In a fiat system, the cost of policy does not always arrive as an invoice. It arrives as higher prices, lower purchasing power, higher debt service asset inflation, and future obligations. This is why I always return to cause and effect. A government match into retirement accounts can help workers invest, but if the match is financed by more debt and monetary expansion, it can also contribute to inflation and asset price inflation. Both can be true. A policy can help one part of the system and create pressure in another part. That is how systems work. Now let us look at the market impact. The stock market is priced through supply and demand. That sounds simple, but it is often forgotten. When there are more buyers than sellers, prices rise. When there are more sellers than buyers, prices fall. The 401k system has been one of the biggest structural sources of buying in the U.S. stock market for decades. Every paycheck, money flows into retirement plans. Some of that money buys index funds, target date funds, mutual funds, and other investments that create steady demand for stocks. The growth of IRAs created another channel. The rise of zero-commission brokerage apps created another channel. Now the Trump IRA may create another channel if millions of workers who did not previously have an employer retirement plan begin contributing. And if the government adds matching funds, more money flows into financial markets. The source estimates that this could bring roughly $32 billion to $68 billion of new dollars into the stock market. The exact number may change. The direction is what matters. More access, more contributions, more government matching dollars, more automatic demand. In a market driven by flows, this matters. It does not mean stocks only go up. That is an important point. Markets will still crash. Recessions will still happen. Valuations will still matter. Earnings will still matter. Interest rates will still matter. Geopolitics will still matter. Liquidity cycles will still matter. But structural inflows can support asset prices over long periods. This is one reason the U.S. stock market has benefited so much from retirement account architecture. Workers contribute automatically. Employers match. Plans buy funds. Funds buy stocks. The demand repeats every pay period. When you create a new retirement channel, you potentially create a new buyer base. That is why investors should pay attention. The financially savvy ask, where is the money going? If the money is going into broad U.S. stock market funds, then broad market exposure may benefit. If the money is going into S&P 500 style products, large cap U.S. stocks may benefit. If the accounts are restricted to low fee index type funds, then passive flows may strengthen. If millions of small contributions enter the system, the market receives a new stream of demand. Again, not a guarantee of rising prices, but a structural tailwind. This is why the source mentions simple vehicles like VTI and SPY. VTI gives exposure to the total U.S. stock market. SPY gives exposure to the S&P 500, the 500 largest companies in the U.S. market. These are not recommendations here. They are examples of how investors think about owning where money flows. If new retirement accounts push dollars into broad equity markets, total market and S&P 500 funds are natural places to understand. The bigger lesson is this. If the government creates a new forced or incentivized investing channel, do not look only at the participant. Look at the assets that receive the flow. That is how policy becomes investment opportunity. Now, the inflation side is just as important if the program is funded through debt, and that debt eventually requires more money creation. The dollar can weaken in purchasing power when more dollars are created without a matching increase in real goods and services. The value of each dollar can decline. People often misunderstand this. Printing money does not print wealth. It prints claims on wealth. If the real economy produces more goods, services, productivity, and innovation, then money growth can be absorbed more easily. But if money grows faster than real output, prices tend to rise. This is why inflation is not just about greedy companies, supply chains, or foreign shocks. Those matter. But monetary expansion also matters because it changes the number of dollars chasing the available goods and assets. Now here is the political irony. The Trump IRA may be presented as a way to help lower-income workers build wealth. That may be true. But if the same policy also contributes to inflation, the same workers can be harmed through higher prices. This is the double-edged sword of government money. It can help people buy assets. It can also make the cost of life higher. The winners are usually the people who understand the system and convert dollars into productive assets early. The losers are often those who receive dollars, keep them as cash, spend them into rising prices, or never become owners. This is why financial education matters. If more money is being pushed into the stock market, the person who understands ownership can benefit. The person who only sees the benefit as free cash may not. The system rewards the owner. That has been one of the defining truths of the modern economy. When money is created, asset prices often rise. Stocks rise, real estate rises, gold may rise, businesses rise, the owners of assets benefit. Workers who rely only on wages and savings may see higher costs and feel poorer. This is not moral commentary, it is mechanics. If you want to survive in an asset inflationary system, you must learn to own assets. That is the deeper lesson of the Trump IRA. It is not only a new account, it is another sign that the government wants more people in the asset system. And perhaps more importantly, that the government may continue using debt and liquidity to support financial assets. That does not mean you should blindly buy anything. It means you should understand the direction of incentives. Now let us think about volatility. When new money enters markets, prices can rise. But when prices rise because liquidity is abundant, volatility often rises too. Why? Because liquidity creates enthusiasm. Enthusiasm creates speculation. Speculation creates overvaluation. Overvaluation creates fragility. Then a shock arrives. Rates rise, earnings disappoint. Inflation returns, a recession begins, credit tightens, and the same market that rose on liquidity can fall sharply when sentiment changes. So structural inflows do not eliminate crashes. They may actually amplify cycles. Free money and easy access can increase participation, and more participation can create bigger swings. This is important. The stock market may benefit from new inflows, but that does not make it safe in the short term. It makes it potentially more supported over long periods while still capable of violent drawdowns. That is where opportunity appears. Market crashes create fear. Fear creates lower prices. Lower prices allow disciplined investors to buy good assets at discounts. This is why the source says recessions and crashes create more millionaires than ordinary times. That statement is not because crashes are fun. They are not. It is because asset prices fall when emotions are worst. People who have cash, courage, and a system can buy ownership when others are selling. But to do that, you must not be the person forced to sell. You need liquidity, you need a plan, you need income, you need diversification, you need emotional control. You need to understand that volatility is not the enemy if you are prepared. The enemy is being unprepared when volatility arrives. Now, from the standpoint of a low-income worker, the Trump IRA may create a meaningful opportunity. If the government offers a 50% match up to $1,000, that is powerful. Suppose a worker contributes $2,000 in a year. The government contributes $1,000, that is $3,000 going into the account. Before any market return, the worker has received a 50% boost on the contribution. That is difficult to beat if the money is then invested in a low-fee fund and compounded over decades. The impact can be significant, but the worker must actually contribute. That is critical. The match is not automatic in the full sense. The worker must put in money to receive the match. If a low-income worker cannot afford the $2,000 contribution, the full match may not be captured. This is an important limitation. A program can offer a match, but people living paycheck to paycheck may struggle to contribute enough to receive it. That is why personal cash flow still matters. Government structure can help, but household surplus is still required. The worker must have the ability to spend less than they earn, or earn more, or allocate the money before it disappears into expenses. If there is no surplus, even a good retirement account cannot be funded. This is the hard truth. Account structure does not replace income. It channels income. A worker who qualifies should treat the match seriously, but also build a budget that makes contribution possible. Small amounts matter. If the minimum is $5, then starting is easier. But to capture the full match, the contribution level matters. Now, from the standpoint of fees, the Trump IRA's fee cap could be one of its strongest features. If the fee cap is truly 0.15%, that makes it much cheaper than many existing 401k arrangements. Low fees create a larger share of the return for the investor. Over decades, that difference is enormous. But a fee cap alone does not guarantee good outcomes. The investment menu matters, asset allocation matters, participant behavior matters. If participants panic sell, chase trends, or withdraw early, low fees cannot save them. The best retirement account in the world still requires proper use. That means investors must understand the basics. Diversification, long-term horizon, low fees, consistent contributions. Avoiding panic. Avoiding unnecessary withdrawals. Rebalancing, not treating retirement money as emergency spending. This is the educational gap. The account can be created by policy. The behavior must be learned by people. Now, portability is another major improvement. If implemented well, if an account follows the worker rather than the employer, it reduces fragmentation. Workers can change jobs without losing connection to the retirement system. Gig workers can contribute part-time. Workers can participate. People outside the traditional corporate benefit structure are not automatically excluded. This fits the modern labor market better. But again, access is not the same as success. Many people already have access to IRAs, brokerage accounts, and investment apps. They still do not invest because they lack surplus, confidence, education, or trust. The Trump IRA may reduce friction, but it cannot eliminate the need for financial literacy. That is why the narrative must be honest. The account can help, but it is not a miracle. Now, let us look at the government debt side more deeply. The United States government's deficit is already large. If a country is collecting $5 trillion and spending $7 trillion, it must borrow the difference. That means issuing more treasury debt. Investors buy treasuries because the U.S. government is viewed as highly creditworthy and because the dollar is the global reserve currency. But even a strong borrower cannot ignore the cost of debt forever. When debt rises, interest expense rises. When interest expense rises, the government must either collect more revenue, cut other spending, borrow more, or rely more heavily on monetary support. This creates a loop. More debt can require more borrowing. More borrowing can require more buyers. If buyers demand higher yields, interest costs rise. Higher interest costs increase deficits. Deficits require more borrowing. This is the debt spiral risk. A new program by itself may not break the system, but every new spending commitment adds to the direction. This is why the funding question matters. It is not enough to say the government will give you $1,000. You must ask where the $1,000 comes from. If it comes from taxes, one group pays directly. If it comes from debt, future taxpayers pay or bondholders absorb the risk. If it comes from money creation, everyone holding dollars pays through dilution. The method determines the cost distribution. And in a highly indebted system, the line between debt and money creation can become blurry over time. That is why the source connects the Trump IRA to inflation. When government spending rises without matching revenue, the pressure eventually shows up somewhere. Inflation is one way the pressure is transferred. Now, does that mean the Trump IRA alone will create massive inflation? Not necessarily. The scale matters. $32 billion to $68 billion in market inflows is meaningful. But in the context of the entire U.S. economy and stock market, it is not gigantic by itself. However, the program is part of a larger pattern. Government deficits, tax cuts, retirement incentives, asset support, money creation during crises. A political preference for avoiding hard austerity. Each one may be manageable alone. Together, they contribute to a system that favors financial assets and pressures the dollar over time. That is the framework. Do not isolate one policy. Place it inside the broader debt cycle. A debt-heavy government tends to choose inflation over default because inflation is less visible. Default is explicit. Inflation is gradual. Default creates immediate political crisis. Inflation can be blamed on many things. This is why fiat systems often erode slowly. A person who holds only cash may not notice the loss in 1 month. But over decades, the loss is enormous. This is why retirement investing becomes more important, not less. If the dollar is being diluted, workers need assets that can grow faster than the dilution. Stocks are one way, real estate is another, businesses are another, hard assets are another. The exact portfolio depends on the person, but the principle is ownership. Own things that can adjust to inflation, own productive assets, own claims on real economic activity. Do not rely only on the currency. Now, what kind of investments may benefit from the Trump IRA structure? The most direct beneficiaries are broad U.S. equity markets. If the account channels money into stock funds, total market funds can benefit from broad inflows. S&P 500 funds can benefit if the default investment options include large cap exposure. Asset managers that run low cost funds may benefit if they administer or receive flows. Brokerage platforms may benefit if account infrastructure expands. Large companies inside the indexes may benefit indirectly from increased passive buying. But remember, broad inflows may not make every stock a winner. Bad businesses can still decline. Overpriced sectors can still correct. Index construction matters, valuation matters, earnings matter. The simplest way for many people to express the structural flow thesis may be broad market exposure rather than picking individual winners. But financially savvy investors may also look at the ecosystem around the program who administers the accounts, which fund companies receive assets. What default options are permitted? Are the investments restricted to low-fee index funds? Are target date funds included? Which custodians handle the accounts? What technology platforms support them? Where does the money actually land? These details matter. Policy creates the channel, implementation decides the flow. Investors must watch the implementation. Now, there is a risk that government-directed retirement flows increase market dependence on policy. If more and more retirement wealth depends on the stock market, policymakers have an even stronger incentive to support markets during downturns. This already exists. The stock market is not just a casino, it is the retirement system for millions of people. When markets fall sharply, household wealth falls, consumer confidence falls, retirement security weakens, political pressure rises, and central banks are pressured to respond. If the Trump IRA expands the number of Americans directly tied to market performance, that political sensitivity may increase. This can create a self-reinforcing loop: more retirement money in markets, more political need to support markets, more liquidity during crises, more asset inflation, more inequality between owners and non-owners, more pressure to get non-owners into markets. That is how systems evolve. Again, not all good, not all bad, a system with benefits and risks. Now, think about the low-income worker. If this worker does not invest, inflation hurts them. If they invest and markets rise over long periods, they can build wealth. If markets crash early, they may feel pain and quit. If they get a match, the match can cushion some risk. If fees are low, more returns stay in the account. If the account is portable, they can keep going across jobs. This can be genuinely positive if combined with education and discipline, but if the government funds it with debt and money creation, the same worker may face higher living costs. This is why financial systems are not simple. A person can benefit as an investor and suffer as a consumer at the same time. The only rational response is to become a better investor. If the system is designed to move money into assets, you should understand assets. If the system dilutes the dollar, you should understand purchasing power. If the system rewards ownership, you should become an owner. This is not ideology, it is adaptation. Now let us revisit fees, because this is one of the cleanest lessons. Expense ratios seem small because they are expressed as percentages: 0.15%, 1.26%, 1.5%. But wealth is built through compounding, and fees compound in reverse. A high fee does not only take money this year, it removes money that could have compounded every future year. That is why the $139,000 fee difference in the source S example is so powerful. The worker did not lose $139,000 in one obvious transaction. The worker lost it through small annual drags that compounded. This is one of the most important personal finance lessons. Small leaks become large losses over time. A retirement investor should know every fund's expense ratio, not vaguely. Specifically, if you have a 401k, open the plan and look. If you have an IRA, look. If you own mutual funds, ETFs, target date funds, or managed products, look. A higher fee is not always wrong. Sometimes an active manager may justify a fee through better risk-adjusted returns, tax strategy, or specialized exposure. But you must know what you are paying and why. If you pay more and receive the same or worse performance, you are transferring your future wealth to the manager. That is not investing, that is leakage. Low fees are one of the few things investors can control. Control what you can control. Fees diversification, time horizon, savings rate, behavior, taxes where possible. Do not obsess over what you cannot control while ignoring what you can. Now let us think about the match. A match is almost always a very powerful return. If the government offers 50% on eligible contributions, that is a huge incentive. But again, contribution is required. The full $1,000 match requires the worker to contribute $2,000 under the Source S framework. For someone making under $20,500, contributing $2,000 is not easy. That is almost 10% of gross income. For a low-income household, that can be very difficult. This means the program may most benefit lower-income workers who still have enough cash flow discipline to contribute. The people who are too financially squeezed to contribute may receive less benefit. That is a common problem with match savings programs. They reward participation, but participation requires surplus. This is why income growth, budgeting, and debt reduction remain critical. The account structure can only multiply the dollars that enter it. It cannot multiply dollars that never arrive. Now, what about people who make too much to receive the match? They may still benefit indirectly if the program supports markets, but they do not receive the government contribution. For them, the key lesson may be broader. Use low-fee accounts, check expense ratios, invest consistently, own where structural flows are moving, prepare for inflation. Understand that government programs can support assets while weakening the currency. A person does not need to qualify for the match to learn from the policy. The policy reveals the direction of the system. Now, the source suggests the program begins in 2027. Timing matters. If implementation is scheduled for 2027, investors have time to watch details. This is not a reason to panic today, it is a reason to prepare. Watch the final rules, watch the fund options, watch custodians, watch contribution limits, watch income thresholds, watch match mechanics, watch how the money is funded, watch congressional and administrative changes, watch whether the policy survives political and legal challenges. A disciplined investor does not assume the first announcement is the final structure. Policy evolves. Executive orders can be challenged, modified, expanded, delayed, or implemented differently than advertised. So the correct response is not blind certainty. It is monitoring, but the direction is still important. The government is trying to create another retirement channel that is a signal. Now, if I were framing the Trump IRA for an ordinary worker, I would say this. If you qualify for the match and can afford to contribute, take the match seriously. A 50% match is not common. Use the account if the rules are favorable, the fees are low, and the investment options are sensible. Do not treat the match as spending money. Treat it as a seed. Put it into diversified, low-cost investments aligned with your age, risk tolerance, and retirement goals. Do not panic when markets fall. Do not withdraw early unless truly necessary. Do not assume the government contribution makes the investment risk-free. It does not. The match helps. But the market still moves. Use the system with discipline. Now, if I were framing it for an investor, I would say this. Watch the flow. If $32 to $68 billion of new money enters the stock market, it can support broad equity demand. Broad U.S. market funds and S&P 500 exposure may benefit from the same kind of structural buying that has already supported the market through 401ks and IRAs. But do not extrapolate into fantasy. Markets still cycle. More money can mean higher valuations, and higher valuations can mean lower future returns if earnings do not keep up. Structural inflows can support the market, but they cannot repeal business cycles. So use dips, use diversification, use valuation awareness. Do not chase blindly. Now, if I were framing it for the macro thinker, I would say this. The program is another example of fiscal policy, retirement policy, and market structure becoming intertwined. The government wants people to invest. The government may borrow to help them invest. That borrowing may increase debt. That debt may contribute to monetary expansion. Monetary expansion may support asset prices and pressure purchasing power. Workers are pushed into markets to protect themselves from inflation that policy itself may help create. That is the loop. It is a very modern loop, and once you see it, the world makes more sense. People are told to save for retirement and financial assets because cash loses value. Cash loses value partly because the monetary and fiscal system expands the supply of dollars. The solution to that debasement becomes owning assets. The government then creates more systems to push people into assets. Those flows raise asset prices. Rising asset prices help owners. Non-owners fall further behind. Then new programs are created to help non-owners become owners. The machine continues. This is why understanding how money works is so important. If you only work, save cash, and avoid investing, The system slowly moves against you. If you understand the system, you can position yourself on the side of ownership. That is not about politics, it is about mechanics. Now, there is a moral question. Should the government borrow more money to fund retirement matches? That is not a simple question. Helping low-income workers invest is a worthy goal. The lack of retirement access is real. High fees are real, portability problems are real, the absence of employer matches for many workers is real, but fiscal reality is also real. A country already running large deficits must be honest about the cost of new benefits. If the program is not funded through taxes or spending cuts, it is funded through borrowing. Borrowing shifts burden. Money creation dilutes. Those costs may be hidden, but they exist. This is why policy debate should not be reduced to good people versus bad people. A policy can have noble intentions and still create trade-offs. The goal is to understand the trade-offs. Now, what should ordinary people do? First, if you have a 401k, examine it. Look at the expense ratios, look at the match, look at the investment options, look at whether you are contributing enough to get the full employer match, look at whether you are paying too much in fees, look at whether your asset allocation makes sense. Do not assume your 401k is good simply because it exists. Second, if you do not have a 401k, understand your alternatives, IRAs, Roth IRAs, taxable brokerage accounts, self-employed retirement plans, and if the Trump IRA becomes available, understand whether you qualify. Third, if you qualify for a match, do the math. How much must you contribute to receive the full government contribution? Can you afford it? Can you automate it? What investments are available? What are the fees? Fourth, think beyond the account. More government spending may support assets and weaken the dollar over time. That means your larger strategy should not rely only on cash. You need exposure to productive assets if your time horizon and risk tolerance allow it. Fifth, prepare for volatility. More money in markets does not prevent crashes. In fact, more participation can create larger emotional swings. Have a plan for downturns. 6. Keep investing education as a permanent skill. The system changes, tax laws change, programs change, markets change, but the principles remain: low fees, long time horizon, diversification, consistent contributions, avoiding panic, understanding inflation, owning assets. Those principles keep working across systems. Now let us come back to the phrase Trump IRA itself. The name will cause people to argue. Some people will support it because of politics. Some will reject it because of politics. Both reactions can make investors stupid. Do not let political emotion prevent financial analysis. If a policy creates a new capital flow, analyze the flow. If a program offers a match, analyze the match. If the funding requires debt, analyze the debt. If the policy supports asset prices, analyze the opportunity. If the policy increases inflation risk, analyze the hedge. Politics is the surface, incentives are the system, capital flows are the reality. Investors should focus on reality. Now, what is the single biggest opportunity? The obvious answer is broad stock market ownership, because the new accounts may send more money into broad U.S. equities. Total market funds and S&P 500 funds are the cleanest expression of that broad flow. But the deeper opportunity is education. The person who understands this system will act differently. They will not leave money in high-fee funds without questioning it. They will not ignore employer matches. They will not dismiss government matches. They will not think free money has no cost. They will not sit entirely in cash while inflation erodes their savings. They will not panic when markets fall. They will recognize that volatility creates buying opportunities when the long-term system still supports ownership. They will think like asset owners. That is the real advantage. Financial education turns policy into opportunity instead of confusion. Now, what is the biggest danger? The biggest danger is that people treat the government contribution as a guarantee and stop thinking. They may contribute to get the match, but invest poorly. They may chase risky assets inside or outside the account. They may ignore fees if the cap is not enforced well. They may withdraw early. They may believe markets only go up because the government is pushing money in. They may underestimate inflation. They may fail to build emergency savings. They may become dependent on policy rather than building personal discipline. A government account can provide a tool. It cannot provide wisdom. Wisdom must be built. Now, let us think about how this changes the retirement landscape. The 401k was designed for a world of employer-based benefits. It works well for some people, badly for others, and not at all for those without access. The Trump IRA, if implemented as described, moves retirement access away from the employer and toward the worker. That is a major conceptual shift. The retirement account becomes more portable. The fee structure becomes more controlled. The minimum becomes lower. The match becomes government, funded rather than employer, funded for qualifying people. This could make retirement investing more universal. But it also makes the government a more direct participant in pushing money into markets. That is the trade-off: more inclusion, more fiscal involvement, more market flow, more debt pressure, more inflation risk. Again, both sides. This is how I would summarize it. The Trump IRA could solve real problems in access, fees, portability, and minimums. It could give low-income workers a valuable match. It could bring billions of new dollars into the stock market. It could support asset prices through new structural demand. But it could also increase government spending, add to deficits, require more borrowing, and contribute to inflationary pressure if financed through debt and money creation. This means the account may help people become investors, while also reinforcing the very system that makes investing necessary. That is the irony. The dollar weakens over time. The government creates a program to help people buy assets. The program may require more debt. More debt can weaken the dollar further. Assets rise, those who own assets benefit. Those who do not fall behind. The answer is not to complain about the machine. The answer is to understand it. If the machine rewards ownership, become an owner. If the machine punishes high fees, lower your fees. If the machine prints money, protect purchasing power. If the machine sends money into equities, understand equities. If the machine creates volatility, be ready to buy when others panic. That is the practical lesson. Now let us end with the most important point. This is not a reason to blindly buy stocks. It is not a reason to trust government promises without question. It is not a reason to assume retirement is solved. It is not a reason to ignore deficits. It is not a reason to pretend inflation does not matter. It is a reason to think like a system designer. Your retirement depends on flows. Your purchasing power depends on inflation. Your wealth depends on ownership. Your outcome depends on fees, contributions, tax structure, market returns, and behavior. The Trump IRA may become another tool in that system. Use it if it helps you. Analyze it if it changes markets. Question it if it increases debt. But do not ignore it, because when the government creates a new pipeline for money to enter financial markets, the financially uneducated see politics, the financially educated see flows. And in markets, flows matter. The 401k changed America's investment system. IRAs changed it. Zero commission brokerage changed it. A government-matched, portable, low-fee retirement account could change it again. If you are eligible, understand the match. If you are an investor, understand the inflow. If you are worried about inflation, understand the funding. If you are building wealth, understand that the system keeps pushing people toward assets because cash is being weakened. That is the lesson. The Trump IRA is not just a retirement account, it is a signal. The government wants more Americans inside the stock market. The government may borrow to put them there. That can make asset owners richer and cash holders poorer. So learn the rules, watch the money, control your fees. Own productive assets, prepare for volatility. And never forget that the most expensive kind of money is often the money people call free.